other print disability, which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at nfradioreading.org.
Hello, this is Dasha, and for the next hour I'll be reading from the Friday, April 24th issue of the Wall Street Journal on the Niagara Frontier Radio Reading Service. Looking at the front page, in amid all these regular stories, which would be in your other news, Oracle's AI debt pushes investors to limit. Funding snag poses risks to data center boom, limiting access to capital, by Peter Rudiger and Burbagin. Oracle's $300 billion mega deal with OpenAI is testing the limits of Wall Street's appetite for debt tied to the U.S.'s data center boom. Banks, including J.P. Morgan Chase, struggled for months to spread the risk of billions of dollars in loans they made to build data centers leased to Oracle in Texas and Wisconsin. People familiar with the matter said. Many financial institutions that would ordinarily buy those loans face restrictions on how much exposure they can have to a single counterparty, and the sheer size of these debt packages pushed them to the limit with Oracle. As a result, bank balance sheets got clogged, constraining the financing prospects of future projects tied to Oracle and OpenAI. For example, lenders balked at financing the expansion of a data center complex in Abilene, Texas, if Oracle were the tenant, according to people familiar with the matter. That led the developer, Crusoe, to lease it to Microsoft instead. The challenges surrounding Oracle highlight a risk for the multi-trillion-dollar data center boom, where limited access to capital compounds obstacles caused by a strained electric grid and a growing public backlash. Any slowdown in data center construction and completion would stymie a build-out that AI players desperately need. Some top AI companies appear to be hitting the limit of what they can offer users as demand for computing firepower, which is provided by data centers, exceeds supply. Lenders grew more comfortable with Oracle-related projects after the company said it would raise all the money it needed for 2026 by issuing about $50 billion in stock and bonds. Oracle said in a post on X last week that each data center it's developing for OpenAI is moving forward on time. But even after it raises that amount, Oracle still has additional cash funding needs of $100 billion or more for 2027 and the first half of 2028, according to Morgan Stanley credit analysts. We've pondered how Oracle's considerable funding needs over the next 3 years may test the depths of different fixed-income markets, the analysts wrote in February. We are proud of the rapid progress that's been made, both in financing and developing our data centers, an Oracle spokesperson said in an email. Our partners have diversified their capital sources in ways that enable us to keep construction moving forward on time and as planned. It isn't just Oracle, a 49-year-old database and software company that has a lot riding on its transformation into an AI computing provider. OpenAI is counting on Oracle to deliver the capacity it needs to scale ChatGPT's growth ahead of a hoped-for public listing. Silicon Valley needs access to debt to meet its goals for AI-related spending. Big tech companies are expected to generate enough cash to cover only about half of the $3 trillion they are projected to spend on AI through 2028, according to analysts at Morgan Stanley. The rest has to come from banks, corporate bonds, private credit, and other forms of financing. So far, Wall Street is largely giving a blank check for the AI ambitions of the most creditworthy tech companies such as Google, Microsoft, and Meta. Oracle, though, is in a comparatively weaker financial position than big tech rivals. It has a lower investment-grade credit rating, more debt, and is burning cash. Much of its future revenues tied to a money-losing startup that's facing growing competitive pressure. The cost of protecting Oracle's bonds against a potential default via credit default swaps roughly quadrupled between late September and late March, though it has fallen slightly since then. That has made lenders nervous about putting too much money into projects tied to the company, whose shares have declined by over 30% in the past 6 months. Much of the borrowing tied to the OpenAI mega contract was done by data center developers working with Oracle. The debt was structured as short-term construction loans meant to be syndicated among a group of banks and other institutions. Oracle is the tenant, and OpenAI is the subtenant on the deals, but the debt doesn't sit on Oracle's balance sheet. These loans were among the largest ever deals in project finance, bankers said. About $10 billion in loans were taken out for Crusoe to develop the original OpenAI site in Abilene. Vantage Data Centers is constructing a campus in Shackelford County, Texas, and another in Port Washington, Wisconsin, with $38 billion in borrowed money. A stack infrastructure project for a fourth OpenAI facility in Dona Ana County, New Mexico, raised about $18 billion. To manage risk, banks and institutional investors typically have rules capping their exposure to a single counterparty or tenant. Those concentration limits emerged as an obstacle when a group of banks was syndicating some of the loans in late 2025 and early 2026, the people said. It still took months. Vantage said the loans for its Texas and Wisconsin projects with Oracle were largely syndicated in the fourth quarter of last year and are expected to close in the second quarter of this year. The underwriting and distribution garnered more than 50 lenders, with all underwriters achieving successful syndication levels, a Vantage spokesperson said in an email. Some large banks that funded other deals sat out a Michigan data center campus being built for Oracle. Related Digital, the developer building the site, chose Bank of America to take the lead on arranging financing, people familiar with the matter said, in part because it didn't have as much Oracle exposure. Related decided to issue bonds for the deal after seeing the indigestion in the construction loan market. Money manager PIMCO is set to buy a chunk of the deal. Canadian Prime Minister Mark Carney says irritants hover over trade talks, by Paul Vieira. Prime Minister Mark Carney said officials are ready to either negotiate with the Trump administration on trade or wait it out until the U.S. addresses some of his country's concerns. Trade-related barbs and threats between Ottawa and Washington have picked up as talks on a renewed North American Trade Pact, known as USMCA, have stalled. Meanwhile, negotiations between the U.S. and Mexico are at an advanced stage. Carney said there won't be progress until the U.S. begins to ease tariffs, which run up to 50% on Canadian industrial goods such as steel, aluminum, automobiles, and forest products. Senior Trump administration officials have in turn expressed irritation with the Liberal government's sharp tone on the U.S. and its unwillingness to address what the U.S. considers trade irritants, such as a ban by some Canadian provinces on the sale of U.S. wines and spirits at government-run liquor stores. You know what's an irritant. 50% tariff on steel, 50% tariff on aluminum, 25% tariff on automobiles, and all the tariffs on forest products. Those are more than irritants. Those are violations of our trade deal, Carney said. Rick Switzer, a deputy U.S. trade representative, said Wednesday that Carney was committing, quote, political malpractice in his relatively hardline approach. Canadian officials say they have no appetite to significantly rewrite USMCA and that Ottawa won't agree to more concessions to get talks rolling on keeping the trade treaty intact. In real estate, in this slow market, some houses still sell fast, by Nicole Friedman. The housing market is slow. Mortgage rates and home prices remain prohibitively high for many buyers, but some homes are still selling quickly. These houses are often in the Midwest or Northeast, where the lack of new construction keeps a lid on supply. Certain homes in other markets are selling quickly too, often when a home is move-in ready. The most sought-after properties are selling unusually quickly compared with the rest of the market for this time of year. The typical home for sale in March had been listed for 56 days, according to Zillow. But homes that went under contract in March spent a median of only 19 days on the market. The 37-day gap between the days on the market for all homes for sale and those that went under contract was the widest for any March since 2020, right before the start of the pandemic housing boom. The gap was also up from a low of 9 days in April 2022, a month after the Federal Reserve raised interest rates for the first time in years, and buyers were eager to purchase before mortgage rates rose further. 4 years ago, people were buying homes indiscriminately, said Kara Ng, senior economist at Zillow. Today, the bar is higher. A lot of the difference between homes that sell and those that sit come down to sellers asking too much for their homes, still hoping to get the same price as a neighbor who sold when prices were soaring. For the right home, even sluggish markets have some bidding wars. In Tampa, Florida, 16% of homes that went under contract in February did so within 7 days of going on the market, according to Zillow. Of that 16%, almost 1 in 3 sold for above their listing price. High home prices, elevated mortgage rates, and other rising costs are making buyers nervous. They're hesitant to buy homes that are outdated or need repairs because of the uncertain cost of renovations. An older home can also raise a buyer's home insurance costs or make it difficult to obtain insurance at all. Buyers are willing to jump quickly on homes that are priced right and renovated, with no major repair issues, real estate agents say. About 34% of existing homes on the market need repairs or updates, but many of those sellers prefer to sell their homes as is, according to a March survey of real estate agents by John Burns Research and Consulting. Jake Cross and his wife listed their renovated house in St. John, Indiana for sale in March for about $300,000 after buying a larger home. There's absolutely nothing for sale in the $300,000 range that looked modernized at all, Cross said. It seemed like it would be a decent time. The first buyer who toured the house the day after it listed put in an offer slightly above the asking price, which Cross and his wife accepted. Pricing strategy can also be a challenge. Almost half of potential sellers surveyed by Realtor.com in March expected to receive their listing price, and more than 1/3 expected to sell for above the listing price. News Corp, parent of the Wall Street Journal, operates Realtor.com. Commercial nuclear power moves forward in 2 states, by Jennifer Hiller. The first commercial nuclear power projects in a decade are now under construction in the U.S., a potential turning point for a segment of the power industry that has been stuck in neutral for years. A project by TerraPower, a company founded by Bill Gates almost 20 years ago, started construction Wednesday in Wyoming, while Kairos Power broke ground last week in Tennessee on a plant that intends to sell power to Google. For years, nuclear power's would-be revival has been more concept than reality, with little under construction. The renewed interest comes alongside the biggest jump in electricity demand in a generation, much of it driven by the need to power data centers for artificial intelligence. TerraPower and Kairos are among the developers trying to prove smaller, streamlined reactor designs can overcome the problems the industry is known for: cost overruns and delays. This isn't a test reactor, said Chris Levesque, president and chief executive of TerraPower. This is a grid-scale nuclear reactor that will be built in 42 months. Traditional U.S. reactors use water to cool the reactor core. TerraPower will use liquid sodium, which has a higher boiling point and allows operations at lower pressures, with a more streamlined design than conventional projects. The 345-megawatt plant will include an energy storage system that could boost output to 500 megawatts during times of peak electricity demand. The TerraPower reactor will deliver electricity into Utility Pacific Corp's multi-state transmission system. Gates is still a major investor in TerraPower, which is privately held. InVentures, the venture capital arm of NVIDIA, and shipbuilder HD Hyundai are among other big backers. In Oak Ridge, Tennessee, the first Kairos plant will supply up to 50 megawatts of electricity to the Tennessee Valley Authority. The Kairos reactor is licensed for research and development, but is still allowed to produce and sell electricity. Supplying power to TVA will help to offset the carbon emissions of Google data centers in Tennessee and Alabama. The tech company agreed in 2024 to buy power generated by several Kairos reactors and hopes to receive up to 500 megawatts of nuclear power over the next 10 years. Keros uses molten fluoride salt as a coolant, allowing it to operate at low pressures and high temperatures. You're listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. In world news, Eurozone debt eases, but outlook is gloomy, by Paul Hannon. Eurozone governments cut borrowing in 2025, but their combined budget deficit is expected to widen this year, driven by support for households hit by the jump in energy prices that has accompanied the conflict in the Middle East. The COVID-19 pandemic pushed European government borrowing sharply higher, but it has since fallen relative to the annual economic output, despite high levels of spending in support of households and businesses as energy prices surged in the wake of Russia's full-scale invasion of Ukraine. The European Union's Statistics Agency said Wednesday that the gap between the amounts spent by the 20 governments that were members of the Eurozone in 2025 and their tax revenues edged down to 2.9% of gross domestic product from 3% in 2024 and a recent high of 7% in 2020. The accumulated debts of those governments rose to 87.8% of GDP from 87% in 2024, but were down from their 2020 peak of 96.5%. However, borrowing seems set to pick up again this year as governments build their militaries to reduce their reliance on the U.S. in the face of a greater perceived threat from Russia, and again provide support for households and businesses facing a jump in energy costs following the U.S. and Israeli attacks on Iran and that country's response. The International Monetary Fund last week forecast the Eurozone's budget deficit would widen this year to 3.3% of GDP. By comparison, it expects the U.S. government's deficit to widen to 7.5% of GDP from 6.8%, and its debts to increase to 126% of GDP from 124%. The fund warned deficits would likely be higher if the conflict in the Middle East and its disruption of energy supplies is prolonged. A quick resolution to the conflict and a reopening of the Strait of Hormuz could see energy prices fall from current levels and limit demands from households and businesses for help from governments. The European Central Bank and the European Commission have been among those calling for a more targeted response than was the case in 2022, when rich and poor households alike benefited from government funds. Governments that try to cushion every shock for every household risk undermining fiscal sustainability at their peril, ECB President Christine Lagarde said recently. Looking at the opinion pages, Political Economics column by Joseph C. Sternberg has Kevin Warsh's plan to save an independent Federal Reserve. You don't normally expect excitement at a Senate confirmation hearing for a Federal Reserve nominee, but then again, it hasn't usually been Donald Trump doing the nominating. So it was that the hearing Tuesday to vet Kevin Warsh as the next Fed chairman generated an unusual quantity of heat and light, particularly surrounding questions of the Fed's institutional independence. Democrats and many investors purport to be alarmed on the point, well, because of Mr. Trump. The president makes no bones about his enthusiasm for low interest rates as economic stimulus. The concern, supposedly, is that Mr. Trump has nominated Mr. Warsh only because he has agreed to bow to Mr. Trump's wishes. This is insulting to Mr. Warsh, whose public career ought to instill confidence that he can think for himself. It's also disingenuous on the part of his critics, particularly Senate Democrats such as Elizabeth Warren. She spent much of her own free time in 2022, 2023, and 2024 writing open letters to Chairman Jerome Powell and an opinion column in this newspaper to demand easier monetary policies for political purposes, such as facilitating financing of renewable energy projects. Bear in mind, however, that the underlying question here isn't whether Fed decision-making should be political. It already is. The central bank, handed a dual price stability and full employment mandate by Congress, chooses to adopt a theoretical approach that assumes it must actively trade off between the two goals. But how much unemployment and how much inflation voters will tolerate fundamentally are political questions. And over time, the Fed has made itself more political. The central bank's propensity for buying and holding large quantities of assets drags it into fiscal arguments where it doesn't belong. For instance, as Mr. Warsh often points out, the question instead is how to manage the Fed's inevitable forays into political decision-making in ways that will maintain the public's confidence in such a powerful institution. Mr. Warsh's answer to this conundrum is more comprehensive than often assumed. His approach relies in part on structural modesty, hence his insistence that the Fed stay in its relatively narrow lane with a smaller balance sheet. Hence also his ambivalence toward, quote, forward guidance, end quote, the speeches, policy statements, and other pronouncements by which Fed officials attempt to steer markets. He added a new layer on Tuesday. The Fed also requires a degree of intellectual humility. Mr. Warsh promised to undertake a major, quote, data project, end quote, regarding inflation soon after taking office, if confirmed. He plans to address economists' difficulty in understanding what is actually happening to the price level from existing methods of collecting and analyzing data, admitting that substantial lacunae exist in the Fed's perception of the economy would address a major sap on its credibility, which is the frequent divergence between what Fed officials think is happening and what voters actually experience around their kitchen tables. More important is Mr. Warsh's desire for messier policy-setting meetings. He suggested he'd welcome more open disagreement among the members of the Federal Open Market Committee, which sets interest rates. These meetings have been marked for the most of the past couple decades by something approaching pathological agreeability. Between September 2005 and September 2024, not once did a member of the Fed's Washington-based Board of Governors dissent from an FOMC policy decision. And it was unusual for more than two presidents of regional reserve banks to vote against a policy move. Meetings appear to have become more fractious in recent months, especially with Trump appointee Stephen Mirren as a reliable dissent in favor of lower rates. But this appearance deceives. Only once in December have 3 FOMC participants voted against a decision. We know they don't all agree with one another to that extent. Fed officials tell us so in their speeches and in the economic projections they publish every 3 months, which reveal uncertainty about economic developments and a range of policy opinions, which is as it should be, given the dramatic transformations underway in the economy these days, as demonstrated by senators' questions about Mr. Warsh's views on how the artificial intelligence boom might affect interest rates. Presumably intended to be reassuring, the thrust toward near unanimity instead has become discrediting. It projects an aura of certainty no economic policymaker should feel, and can leave the public wondering why officials who said one thing between meetings voted another way in the conference room. Encouraging officials to vote their minds is an essential element of any plan to reassure voters that the Fed is acting deliberately and humbly. The common assumption is that institutional independence makes a central bank credible. In truth, a central bank's credibility justifies its independence. Mr. Warsh's efforts to bolster the Fed's credibility will safeguard its independence as well. Another opinion here by Rahm Emanuel, a Democrat who has served as a U.S. representative from Illinois, White House Chief of Staff, Mayor of Chicago, and Ambassador to Japan. Trump's research cuts play into China's hands. America has long been envious of China's advanced trains and factories. The high-speed trains zipping from Shanghai to Beijing puts to shame the Amtrak Acela running half as fast between New York and Washington. The U.S. might have been at the forefront of the Second Industrial Revolution more than a century ago, but many now consider China to be the world's factory floor. While it's true that Beijing dominates manufacturing, Washington's fears of lagging behind miss a profound point. The real threat lies in other economic sectors. Intent on ensuring that China leapfrogs the U.S. as the world's preeminent power, Xi Jinping recently made the gutsy and perhaps counterintuitive decision to invest massively in an arena of American strength, basic research. While a variety of factors drove China to invest in research, the COVID pandemic was a wake-up call that accelerated these efforts. Having seen that Western researchers produced COVID vaccines with higher efficacy rates months before China, Mr. Xi directed his government to close the technological gap across the board. Beijing, over the past 5 years, has directed significant money to quantum computing, fusion energy, military technology, artificial intelligence, and other areas of research and development. Those investments are already paying off, as evident from American pharmaceutical corporations' increasing interest in buying Chinese life sciences assets. While Mr. Xi is investing in China's future, President Trump has proposed in his past 2 budgets to cut funding and cancel research. He has proposed slashing money for the National Science Foundation by more than half, and for the National Institutes of Health by about 40%, later revised to about 12% after congressional pushback. He isn't giving the Energy Department's national laboratories or the Defense Advanced Research Projects Agency the resources they need to keep pace, let alone surge ahead. He has canceled or frozen more than 7,800 science and technology grants. The results are profound. Scientists from around the world used to compete to do their groundbreaking research in the U.S. Now, many look elsewhere, often across the Pacific. Mr. Trump's policy of cutting R&D funding endangers America's competitiveness, imperiling the likelihood that the next Apple, Google, or Amgen will be founded here. But he isn't the only one to blame. Business leaders have watched this disaster unfold, largely without speaking out, in most cases because they didn't want to jeopardize the tax breaks and regulatory relief Mr. Trump was offering to deep-pocketed firms. The tech bros are complicit because Mr. Trump agreed not to regulate AI or crypto. Congressional Democrats have been so distracted in their whack-a-mole efforts to address each successive Trump outrage that they've forgotten to fulfill their most solemn duty, to propose thoughtful, flexible, alternative approaches. Here's how my party can turn things around. First, to keep pace with Chinese, Washington needs to finance a new public investment fund devoted exclusively to science and research. The source of funding should be clear, obvious, and walled off. The industry that now enables online wagering for sports games and predictions hit $400 billion in total trading volume last year, and it's poised to grow. If Washington imposed a 10% transaction fee on those bets, we'd have about $40 billion to augment national investments in basic research, defense, life science, and energy technology. These new resources wouldn't be used to supplant existing funding, but rather to double funding for the NSF, NIH, DARPA, and the Energy Department's national laboratories. We can either be a nation of gamblers or of entrepreneurs. I'm for entrepreneurs. Then we should tighten the existing R&D tax credit, a benefit that's being gamed by firms that are no longer at the cutting edge. Washington could get more bang for its buck if it targeted incremental research, used AI to flag bogus applications, and awarded bonuses to investments in industrial campuses that cluster researchers, suppliers, and manufacturing facilities. The tax credit should no longer be a grab bag for companies that are past the point of pioneering research. For Democrats, this plan doesn't only represent good policy, it's an opportunity to practice good politics. Mr. Trump has tried to have his cake and eat it too. During his campaigns, he claimed to be a tribune for the working class, yet he buddied up to industry titans at his inauguration. Since then, when forced to choose between the two, he has almost always sided with the elite. He has abandoned the MAHA moms for big ag. He has made it more difficult for states to regulate harmful uses of AI. He has shut down clean energy projects that could protect families against high oil prices. As a result, the economy in working-class communities hasn't improved. It's gotten materially worse. Rarely has a president managed to alienate so much of his winning coalition in such a short period. That provides Democrats with a target-rich environment heading into the midterms in 2028. But we'll squander our opportunity if we simply bang at the Trump administration's hypocrisy. Voters need us to convince them and show them that if they support Democrats, they won't get more of the agenda they didn't like last time we were in power. To become the party of economic growth again, we need to offer fresh ideas that keep America competitive as the global landscape evolves. China's investments in science and technology pose a real threat, but by drawing new revenue from the prediction and online sports gambling industry and reforming our tax code, we can invest in our future. Democrats can take the lead on driving research forward and holding Beijing at the bay. I'm tired of watching people win by betting against America rather than betting on our nation's success. The ideas I've outlined are only the beginning, pieces of a broader economic growth strategy to ensure our country's global preeminence for generations to come. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier radio reading service. Moving to the finance and business section, heard on the street, financial analysis and commentary. Money is neither red nor blue. Party poopers. American money's green, not red or blue, but that isn't how some people invest theirs. A clear partisan tinge affects views of stocks and the economy. In September 2024, for example, 2 months before the presidential election, the long-running University of Michigan survey of consumer sentiment topped 70, a decent report. But the number was an abysmal 49.7 among self-identified Republicans and a stellar 92.6 among Democrats. That flipped as soon as President Trump was reelected. A less frequent Gallup survey, specifically about whether the stock market will rise in the next 6 months, hewed to the same pattern. This January, 81% of Republicans, but just 35% of Democrats, thought it would. Those numbers were 22% and 43%, respectively, 2 years earlier. Has there really been a difference in stock market performance based on which party occupied the White House? For what it's worth, yes. Returns on average have been far lower under supposedly pro-business Republicans. Academics have dubbed this the presidential puzzle, but the reasons aren't so mysterious. Presidents Roosevelt, Obama, and Clinton got elected after recessions that were blamed on their Republican predecessors. Then they rode fabulous market rebounds. The upshot is that presidents don't affect stocks much themselves, but stocks might affect who's president. Your feelings about their party might also impact how you remember them. The S&P 500 during Lyndon Johnson's tenure did much better than under his successor, Richard Nixon. Its performance when Joe Biden was president was almost identical to that under Trump's first term. Picking winning and losing sectors was counterintuitive, too. Investors dumped healthcare stocks when Barack Obama, who promised to revamp the industry, was elected. But a popular fund tracking that business rose 218% during his presidency. And when Trump was first elected in 2016, it seemed like oil and gas stocks would boom and green energy shrivel. Instead, a clean tech fund trounced a leading energy fund by 336% points during his first term. Then energy beat the green fund by 213 points during Biden's presidency. Wall Street is only too happy to allocate your savings based on political leanings. An exchange-traded fund with a ticker symbol MAGA launched in 2017. It has trailed an S&P 500 ETF by 75 percentage points, with an expense ratio 26 times as high. Another fund, DEMZ, D-E-M-Z, launched in 2020. It's only behind by a little, mostly because it was heavily overweight tech, with no energy stocks. Purposely avoiding sectors or cutting exposure to stocks based on politics or anything else usually is a recipe for regret. Just stay invested. The other main article in Heard on the Street by Dan Gallagher and Asa Fish is Microsoft needs a co-pilot to get back in the air. Even in the turbulent market of 2026, going from AI winner to AI loser status in 6 months seems excessive. Unfortunately for Microsoft, the complexity of the company's business model also means its new label can't be shaken off quickly. But patient investors should be rewarded, as the world's largest software company by revenue still has notable strengths in the artificial intelligence world. While Microsoft stock has rebounded some recently with other mega-cap techs, it remains about down about 20% over the past 6 months, including a 4% drop Thursday. The company has lost more than $900 billion in market cap from its peak in late October, putting the stock at under 23 times projected earnings. That is a little below the multiple it fetched just before OpenAI launched its ChatGPT in late 2022. Launched its ChatGPT in late 2022, according to FactSet data. That launch made Microsoft the presumed early winner of the AI race, given its prescient investment of billions of dollars in Sam Altman's startup. But 3 years in, that race has racked up huge investment bills with less impressive business contributions, at least apparent ones. Looming large among Microsoft's concerns now is its suite of Copilot AI tools. Copilot got off the ground in late 2023, bringing AI features to Microsoft's ubiquitous productivity software, among other offerings. But while paying users of corporate Copilot software has grown to about 15 million in its latest quarter, they represent only about 3.5% of its enormous user base, according to Bank of America analysts. That isn't tremendous 2.5 years in, especially when considering how the competition is faring. AI developer Anthropic's Claude Cowork AI tools, which autonomously handle common corporate tasks like file management and compiling data, have taken off in recent months, to the extent that Microsoft recently felt the need to add them to its Copilot suite. Paying fees to Anthropic when users tap into Cowork surely makes Copilot less lucrative for Microsoft. The trouble with Copilot is, to some degree, a consequence of Microsoft's decision early in the boom to back OpenAI, a much-hyped mass-market AI developer that didn't make corporate AI its top priority, instead of waiting for an Anthropic to emerge. However, that is a mistake Microsoft can overcome. The company has already demonstrated its adaptability by integrating Anthropic models into software offerings despite its close ties to OpenAI. And Microsoft's huge sales force and existing base of millions of customers gives it commercial leverage that upstart AI developers could only dream of. If and when Microsoft does find a successful formula for corporate AI, it'll be off to the races. Microsoft's other big problem is that growth in its Azure cloud computing business has been slowing. Azure revenue grew 39% in its most recent quarter, down a percentage point from the previous quarter and below Wall Street's expectations. Analysts aren't expecting big acceleration this quarter either. The limiting factor there has been capacity. Microsoft hasn't been able to build AI data centers fast enough to simultaneously run its own software offerings, develop its own AI models, and lease out computing power at an accelerating rate. That isn't a good thing, to be sure. It means competitors are eating its lunch in serving AI workloads. But it is far better than a slowdown caused by lagging demand. Microsoft is also working to develop its own AI models, which consumes computing resources now, but should lead to greater independence from OpenAI later. Given the time it takes to build new data centers and fill them with servers, Azure's capacity issues aren't likely to be resolved soon, even as Microsoft further grows capital spending, Evercore ISI analysts said in a note last month. A return to acceleration for Azure revenue is likely in the second half of the year, they said. Getting Copilot off the runway will also likely take time, years even. Investors will be looking impatiently at the strategy when Microsoft reports quarterly results next Wednesday. The good news is Microsoft has time to figure it all out. Its corporate software offerings are broad, and customers can't readily abandon them for flashy AI alternatives. Its diverse stable of businesses, from cloud computing to the LinkedIn corporate social network, are collectively doing well enough to support more spending on its AI efforts. After riding the crest of the first wave of the AI boom, Microsoft has lost momentum, but its prospects in the AI era haven't faded as much as many investors seem to think. Blackstone's distributable earnings rise with revenue, by Connor Hart. Blackstone's first quarter distributable earnings climbed as the asset manager logged higher revenue and grew its assets under management. Blackstone on Thursday posted quarterly net income of $649.7 million, or 83 cents a share, compared with $614.9 million, or 80 cents a share, a year earlier. Distributable earnings, a closely tracked metric for publicly traded investment firms that pay dividends, rose to $1.76 billion, or $1.36 a share, from $1.41 billion, or $1.09 a share, in the same quarter last year. Analysts polled by FactSet had forecast distributable earnings of $1.34 a share. Fee-related earnings, another metric watched by analysts, climbed to $1.55 billion, or $1.26 a share, from $1.26 billion, $1.26 billion, or $1.03 a share a year ago. Total revenue grew 10% to $3.62 billion, while total assets under management increased 12% to $1.3 trillion. Total dry powder, or unspent capital, stood at $213.3 billion at the end of the recent quarter. Hyundai Motor profit falls despite higher revenue, by Kwanwoo Jun. Hyundai Motor posted weaker first quarter earnings amid sluggish global vehicle sales, as U.S. tariffs, though reduced, continued to weigh on the South Korean auto giant. The tariff hit to the carmaker's profit eased, but remains significant in the first 3 months of 2026 following the trade deal Seoul reached with Washington that lowered duties on most Korean exports to 15% from November. Net profit fell 24% from a year earlier to 2.585 trillion won, equivalent to $1.75 billion for the January to March period, the company said Thursday. The decline slowed from the 52% plunge in the previous quarter. Hyundai executives said on an earnings call that the tariffs cost the company roughly 860 billion won in the quarter. Revenue rose 3.4% to 45.939 trillion won, while the operating profit dropped 31% to 2.515 trillion won. Analysts had expected net profits of 2.480 trillion won on a revenue of 45.866 trillion won in the first quarter, according to FactSet. Global vehicle sales fell 2.5% during the period, reflecting challenging market conditions amid slowing global demand and intensifying competition. The U.S. and Indian markets bucked the trend, with sales rising 0.3% and 8.5% respectively. Higher oil prices amid Middle East tensions led to increased demand for hybrid electric cars, alongside sport utility vehicles in the U.S., Hyundai said. The company had earlier flagged a tough business environment ahead, projecting a similar earnings hit this year after U.S. tariffs cost the company an estimated 4.1 trillion won in 2025. Despite the downbeat earnings outlook, shares of the automakers have climbed about 80% this year. Analysts say the company's push into artificial intelligence and robotics has helped drive the stock higher. In Business Watch, Honeywell sets June 29th for spin-off. Honeywell International is entering the final stages of a multi-year restructuring that will carve the industrial conglomerate into 3 publicly traded companies. Honeywell on Thursday set a date of June 29th to spin off its aerospace business and said it has entered an agreement to sell its warehouse and workflow solutions business to private equity firm American Industrial Partners. Terms of the sale weren't disclosed. The updates came alongside quarterly results that were pressured by disruptions tied to the continuing war in the Middle East. Honeywell said logistical challenges and shipment delays reduced sales by about 1% in the period. The company also reported a lower profit hurt by charges tied to debt restructuring, asset impairments, and separation-related costs. This is by Connor Hart. Lockheed Martin production boost hits cash flow. Lockheed Martin is working to rapidly expand munitions production in the face of surging demand as the U.S. responds to ongoing conflicts and heightened geopolitical tensions. Those investments in production, coupled with the timing of some billings, long-term debt repayments, and cash dividends, caused the defense contractor to burn through more money than expected in the latest quarter. The company reported $291 million of negative free cash flow in the recent first quarter. Lockheed also posted a profit of $1.49 billion compared with $1.71 billion last year's comparable period. Quarterly earnings of $6.44 a share were below the $6.74 a share that analysts polled by FactSet expected. Sales ticked up 0.3% to $18.02 billion. This is also by Connor Hart. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Heineken's upbeat as beer sales dip, by Joshua Kirby. Heineken said it was confident that it would grow its bottom line, booking higher revenue at the start of the year, despite a continued slide in beer sales volumes. The Dutch brewer said Thursday that it made net revenue of 6.7 billion euros, $7.84 billion, between January and March, matching analysts' forecasts, according to a consensus of estimates provided by the company. The increase in revenue came as total volumes turned positive, rising 1.2% on an organic basis from the prior year period, after falling in 2025. Still, beer volumes remained down on a year earlier, with the total boosted by the group's smaller non-beer portfolio of mixers and ciders. Heineken, which alongside its namesake lager brand makes Amstel, Desperados, and Birra Moretti, said it expected operating earnings to grow between 2% and 6% this year, backing guidance it set out earlier in the year. Higher prices helped the company offset lower volumes in some markets in the first quarter, including Brazil and Mexico. That was despite renewed inflationary pressures that threatened to weigh on consumer sentiment ahead, Chief Executive Dolf van den Brink said. Since the start of the year, global trade has become more complex and volatile, with impacts on energy availability and costs in certain markets, said Van den Brink, who is due to leave the company next month. The war in the Middle East has snuffed out green shoots for consumer confidence this year. The mood among American consumers hit its lowest on record, according to a University of Michigan survey published earlier this month. In Eurozone, sentiment is at its lowest in more than 3 years, according to a poll released this week. The company's trading at the start of the year looks fine. Analysts James Edwards Jones and Washington Udamsilpa at RBC Capital Markets wrote in a note. Still, the company is relying on price to boost revenue growth, they said. A cautious mood among drinkers adds to existing challenges for the booze industry, which is facing declining interest in alcohol among younger consumers and is reaching the limits of a previously lucrative strategy of focusing on sales of pricier products. Heineken earlier this year said it would appoint a new CEO as part of a turnaround plan, which includes cutting thousands of jobs across its global operations as it looks to save around €500 million this year alone. Other major brewers are attempting to reposition themselves amid declining beer sales in some key markets. The world's largest brewer, Anheuser-Busch InBev, said this week it would plow $600 million into its operations in the U.S., where it makes Budweiser and other labels. Jessica Toonkel and Kate Clark report that ex-Disney CEO Iger takes an advisory role at firm founded by the brother of the president's son-in-law. Bob Iger is returning to venture capital as he charts his next act after running Walt Disney. The former chief executive officer of Disney, who stepped down from his role last month after a nearly 2-decade run, has taken an advisory role at Thrive Capital, the venture firm founded by Joshua Kushner, according to people familiar with the matter. He will work with the firm's staff on investments and with founders of companies in Thrive's portfolio. One of the people said, Thrive, which recently raised $10 billion for a new set of funds, has backed the likes of Instagram, Spotify, A24, and OpenAI. Kushner is a former Goldman Sachs banker and son of real estate developer Charles Kushner. He's also the younger brother of Jared Kushner, the son-in-law of President Trump. Iger's next move has been the subject of much speculation in Hollywood. The longtime media executive, whose previous attempt at retirement ended abruptly when he returned to the top Disney job, has invested personally in startups and at one point toyed with the idea of running for public office. He's expected to remain on Disney's board of directors through December. For Iger, who owns a stake in Thrive, the move is something of a homecoming. He first stepped down as CEO of Disney in 2020 after a 15-year stint to make way for hand-picked successor Bob Chapek. Iger briefly joined Thrive as a venture partner in 2022, but relinquished the role when he returned to lead Disney later that year after Chapek's firing by the board of directors. During his time at Thrive, Iger met OpenAI CEO Sam Altman. Last year, Iger helped orchestrate a $1 billion deal with OpenAI, by which Disney agreed to license more than 200 of its characters so users could create AI-generated content with OpenAI's text-to-video offering Sora. That deal fell apart after OpenAI decided to scrap Sora. News Corp, owner of the Wall Street Journal, has a content licensing partnership with OpenAI. Between his two stints running Disney, Iger was also involved in a number of entertainment and technology startups. He and his wife, Willow Bay, dean of the University of Southern California's Communication and Journalism School, bought a controlling stake in women's soccer team Angel City FC in 2024. Nicholas G. Miller reports that premium customer strength lifts Amex profit. American Express reported a higher first quarter profit on the back of continued spending from upper-income customers. We continue to see strong demand and engagement with our premium products across our customer base, said Chief Executive Stephen Squeri in a call with analysts. The company said card member spending increased 9% on a currency-adjusted basis, the highest growth rate in 3 years. Meanwhile, spending at luxury retail merchants was up 18% in the quarter, while restaurant spending rose 9%. Airline spending grew 8%, but the company said airline growth softened in March and April because of travel disruptions from the Middle East conflict. American Express also said that spending growth among its millennial and Gen Z clients, which have higher incomes than the rest of their age cohort, has remained robust. It's not every millennial and Gen Z, it's the cream of the crop, Squeri said. For the company's saving products, millennials and Gen Z customers make up over half of the accounts and 1/3 of the balances. It tells you something about the profile of these younger customers that are joining the franchise. They have savings, said Chief Financial Officer Christophe Lecayec. Last year, American Express unveiled its updated consumer and business platinum cards with a higher annual fee. The company is seeing accelerated spend growth following the refresh while maintaining high retention rates, Squeri said Thursday. For the first quarter, the company posted net income of $2.97 billion, or $4.28 a share, up from $2.58 billion, or $3.64 a share, in the prior year period. Analysts polled by FactSet had expected $4 a share. Consolidated total revenue net of interest in expense climbed 11% to $18.91 billion. Wall Street had expected $18.61 billion. Consolidated expenses rose 11% to $13.9 billion. The company said the increase was driven by higher customer engagement costs because of increased card member spending, the refresh of its U.S. Platinum Card, and the usage of travel and lifestyle benefits. The company reiterated its full-year guidance of 9% to 10% revenue growth and earnings of $17.30 to $17.90 a share. Analysts see full-year earnings of $17.56 a share. American Express also said it's decided to increase its investments in marketing and technology. From Money and Investing, some quick spotlight on stocks. Tesla reported better revenue and earnings in the first quarter and surprised Wall Street with positive free cash, but its shares slid 3.6%. Investors are drilling down on the company's announcement that it plans $25 billion on capital expenditures this year as it pursues its AI ambitions. IBM reported rising revenue and a higher profit in the first quarter, but its shares declined 8.3% after the company disappointed investors by keeping its revenue guidance the same. Nestle, the owner of Kit Kat chocolate bar brand and Nescafé coffee, reported a drop in sales, but said real internal growth, which measures the volume of products sold, exceeded expectations. The company's new chief executive has prioritized that metric in his turnaround efforts. Shares jumped 5.9%. Lululemon, the athletic apparel company, announced that it is picking longtime Nike executive Heidi O'Neill to be its next leader as it works to shore up its U.S. business. Lululemon shares fell 9%. Southwest Airlines said its full-year profit guidance is at risk due to rising jet fuel costs. Their shares closed down 4%. American Airlines estimated its fuel costs would jump by $4 billion, but its forecast losses for the year weren't as deep as Wall Street feared. American's shares gained 2.4%. And Avis Budget shares plummeted 48% Thursday, following Wednesday's 38% drop. The car rental company's stock is falling back to earth after an unusual short squeeze sent it surging earlier this month. Earnings are expected coming from Procter & Gamble, Norfolk Southern, HCA Healthcare, and Western Union. You have been listening to a reading of articles and features from the Friday, April 24th issue of the Wall Street Journal. We read from the Wall Street Journal every Monday through Thursday at 11 p.m. and Friday at 6 p.m. Your reader has been Dasha. Thank you for listening.
Coming up next in the Niagara Frontier Radio Reading Service, we have a reading of the Buffalo Criterion, followed at 8 o'clock by the New York Times, and at 9 o'clock by Buffalo Spree. Stay with us for these readings and more throughout the day. The following program is intended for listeners who are blind, have low vision, or have another print disability, which